Daniel Reyes is 38 years old, portfolio manager, Chicago. On the morning of January 27, 2025, he opened his brokerage app 2 minutes after the bell. He watched $140,000 leave his account in real time. He hadn't made a single move. He just owned Nvidia, like millions of people who had spent 2 years watching that stock go vertical. By close, they were all asking the same question. How does the world's most valuable company lose $600 billion, the largest single-day market wipeout in American history? Because of a document nobody had heard of from a startup nobody had taken seriously? No fraud, no earnings miss, no war. Just 22 pages. From a Chinese startup that Silicon Valley had dismissed for years. And that question, the one Daniel Reyes and millions of other investors were asking that afternoon, doesn't have a comfortable answer. But we're going to follow it all the way down. Subscribe to Empire Lane. Power leaves a trail. To understand how far Nvidia fell, you need to understand how high it had climbed. Just 3 days before the crash, on January 24, 2025, Nvidia surpassed Apple to become the single most valuable publicly traded company on Earth. Its stock had risen more than 480% in 2 years, and its CEO, Jensen Huang, had become something nobody expected from a semiconductor executive, a cultural icon. He showed up to tech conferences in a leather jacket. He held up chips the size of dinner plates while crowds went wild. People lined up for his autograph. Tech journalists wrote about him the way entertainment journalists write about movie stars. This wasn't normal for a chip company. Chips are boring. Chips are infrastructure. But Nvidia's chips, specifically its GPUs, had become the literal engines of the AI revolution. Every major AI model, from ChatGPT to Google Gemini to Meta's Llama, ran on Nvidia hardware. The demand was staggering. Microsoft announced $80 billion in AI infrastructure spending for 2025 alone. Meta committed between $60 and $65 billion. At the center of every data center in every one of those build-outs, Nvidia's chips. The logic was simple. More AI means more compute. More compute means more chips. More chips means more Nvidia. Wall Street loved simple logic. By January 20th, Nvidia sat at a peak valuation of $3.7 trillion. The entire GDP of the United Kingdom is around $3.1 trillion. Nvidia was worth more. For the people holding it, the portfolio managers, the retail investors, the engineers with stock compensation, the retirees with tech-heavy funds, this felt like the safest bet in the world. Then someone in Hangzhou, China, uploaded a document. Liang Wenfeng is 40 years old, based in Hangzhou. He ran a quantitative hedge fund called High Flyer. Quiet, methodical, almost impossible to reach for interviews. Starting around 2021, Wenfeng began quietly purchasing thousands of Nvidia H800 GPUs, a version of Nvidia's chip redesigned for the Chinese market after US export controls blocked the more powerful H100 from being sold there. He wasn't building a chatbot. He wasn't chasing venture capital funding. He wasn't posting on X about disruption. He was building something. In May 2023, 4 months after ChatGPT exploded globally, Wenfeng publicly launched DeepSeek. Most people in Silicon Valley either didn't notice or didn't care. The prevailing assumption was that cutting-edge AI required billions of dollars in compute. China was locked out of the best chips, and therefore China couldn't compete at the frontier. That assumption held for almost 2 years. Then, on January 20th, 2025, DeepSeek released its R1 reasoning model. The technical paper that came with it was 22 pages. It explained in precise, reproducible detail how DeepSeek had built a model that matched or outperformed OpenAI's O1 across benchmarks in math, coding, and science. It topped the Apple App Store in the US within days, surpassing ChatGPT as the most downloaded free app in America. And the cost DeepSeek claimed for training it? $5.6 million. For context, OpenAI spent over $100 million training GPT-4. That number would detonate markets 7 days later. By Sunday night, the tech industry's group chats were on fire. Mark Andreessen called DeepSeek's release one of the most amazing breakthroughs he'd ever seen. David Sachs posted that it proved the AI race would be very competitive. Even Sam Altman, CEO of OpenAI, Nvidia's single most important customer, publicly praised it. Monday morning, Nvidia stock began sliding, not gently, fast. Within hours, it was down 10%, then 13%, then 17%. Buy close, Nvidia sat at $118.58 per share, down from near $149 the Friday before. The market cap loss? Close to $600 billion. Larger than Netflix's entire market value, more than double Wells Fargo's market cap. In one session, Nvidia shed a company the size of Goldman Sachs. The sell-off didn't stay contained. Dell, Oracle, and Supermicro each fell at least 8.7%. ASML and Tokyo Electron tumbled. Vistra, an energy company riding the AI data center boom, collapsed nearly 30% in a single day. The Nasdaq slid 3.1%, and while the market was moving, real people were watching real numbers disappear in real time. The teacher who had put her bonus into a tech ETF, the software engineer whose retirement account was heavy in semiconductors, the small investor who had been told, by every financial headline for 2 years, that AI was the trade of a generation. None of them had done anything wrong. None of them had made a single move. They just owned the wrong stock on the wrong Monday. The question markets were screaming wasn't just, is DeepSeek good? It was something more existential. If AI can be built efficiently for millions instead of billions, why does anyone need to spend hundreds of billions on Nvidia chips? Peak GPU, 2 words worth $600 billion. Jensen Huang didn't panic publicly. Nvidia released a careful statement calling DeepSeek an excellent AI advancement and arguing that more efficient models would actually increase demand for GPUs, not reduce it. Their logic: cheaper, faster models mean more people run more AI workloads, which means more inference, which means more chips. It wasn't spin. Serious analysts backed it. Bernstein called the sell-off an overreaction. Tom Lee of Fundstrat compared the panic to the March 2020 COVID crash. Irrational, fear-driven, and ultimately a buying opportunity. The hyperscalers didn't pull back either. Within weeks, Microsoft, Meta, Google, and Amazon's earnings calls confirmed they were increasing AI infrastructure spending. Combined commitments of up to $320 billion for 2025. By February 2025, Nvidia's earnings demolished Wall Street's expectations. Huang told analysts that demand for the next generation Blackwell chips was extraordinary. The company had already sold $11 billion worth of Blackwell systems in the prior quarter alone. The stock recovered. The $600 billion came back, and then some. Daniel Reyes, the portfolio manager in Chicago who watched $140,000 vanish that morning, didn't sell. By mid-February, most of it was back. For him, January 27th became a story he tells at dinner parties. The day he almost panicked, the day he held. But here's where the story gets more complicated than a simple bounce. DeepSeek's cost claims have been contested. SemiAnalysis, a respected semiconductor research firm, estimated DeepSeek's total hardware spend was well higher than $500 million across the company's history, not the $5.6 million figure that went viral. Factor in full R&D costs, servers, operating expenses, and GPUs stockpiled before export controls tightened, and the real number climbs much higher. OpenAI accused DeepSeek of distilling its models, training on OpenAI's outputs without permission. DeepSeek's own later research admitted its base model training data had inadvertently included AI-generated responses from other systems. So, the $5.6 million headline was, at best, an incomplete accounting. But even if DeepSeek's true cost was $500 million, it still built a frontier AI model for a fraction of what OpenAI or Google spent, on chips weaker than what US companies use. That is the real threat. Not that AI suddenly got cheap overnight, but that the efficiency gap is closing. That the assumption, more spending always equals better AI, is no longer guaranteed. DeepSeek didn't kill Nvidia's story, but it put a question mark at the end of it. And in markets, a question mark on a $3.7 trillion company cost $600 billion before lunch. Here is what January 27, 2025 actually proved. Nvidia survived DeepSeek. The stock recovered. the AI build-out continued. Jensen Huang's leather jacket is still selling out conferences, but the crack is visible now. The $600 billion that vanished wasn't a glitch. It was the market asking a question, out loud, in real time, in the accounts of millions of ordinary people, that no one had wanted to answer. What happens when the next Liang Wenfeng isn't in China? When someone with open-source tools and a fraction of the budget builds what OpenAI spends $20 billion a year to maintain? What happens to the teachers and engineers and retirees who trusted the simple logic? More AI means more chips means more Nvidia. When that logic stops being simple, Daniel Reyes got his money back. This time, but $600 billion in one day doesn't happen because of a document. It happens because somewhere underneath the biggest trade in a generation, a question was always waiting to be asked. Cracks like this have a history of becoming something much bigger. Empire Lane. Power leaves a trail.